This past Monday, March 23rd, the market was staring right into the abyss. The week kicked off with this feeling of pure dread. Global tensions were at a fever pitch, and investors, well, they were getting ready for a massive sell-off. I mean, before the opening bell even had a chance to ring, U.S. stock futures were already pointing way down. S&P 500 futures dropped over 0.5%, hitting their lowest point since September. The market was bracing for a complete bloodbath, a sea of red, all driven by the chaos erupting in the Middle East. And then, in an instant, everything changed. A single post on social media. Seriously, that is all it took. Donald Trump announced a 5-day pause on planned military strikes, and he cited very good and productive talks with Iran. Just like that, the entire story, the entire feel of the market, it just flipped on its head. And the market's reaction? It was nothing short of explosive. The Dow Jones shot up more than 600 points, its best day since early February. I mean, think about that whiplash. From the very brink of collapse to a massive rally, all because of one social media post. It really begs the question, why is everything so fragile right now? So to really get a handle on this extreme volatility, we've got to look past Wall Street and get to the root cause, the war in Iran and the shockwave it's sending through the global economy. And believe me, this isn't just some distant news story. It's having a direct and powerful impact on your wallet. The scale of this disruption is, well, it's staggering. We're talking about the Strait of Hormuz, this tiny choke point that handles about 20% of the world's liquefied natural gas and 20 million barrels of oil every single day. And it was effectively shut down. This wasn't some minor hiccup. It was one of the largest supply disruptions in the entire history of the oil market. A massive chunk of global energy just taken offline. And that shutdown, it kicked off this devastating chain reaction. See, the strait closes, which makes oil prices skyrocket. That immediately fuels fears of inflation. And to fight that inflation, central banks are expected to keep interest rates high, which causes government bond yields to spike. And here's the part that really matters to you. When those treasury yields rise, the cost of everything, your mortgage, your car loan, your credit card debt, it all goes up right along with it. A war thousands of miles away is literally making your life more expensive. But here's the thing. While the mainstream market was just waking up to this new reality, another, much more volatile market was already sounding the alarm. For weeks, Bitcoin was acting as a leading indicator, the classic canary in the coal mine for the whole financial system. Just look at this divergence. In the first few weeks of the year, while the S&P 500 was hitting record highs, Bitcoin was quietly collapsing. It fell by a third. For a little while, it seemed like the two markets were just on completely different planets. But then, starting in late February, the stock market started to fall, basically catching up to the weakness that Bitcoin had been signaling for weeks. And this was no coincidence. Analysts like Bloomberg's Mike McGlone were pointing out that Bitcoin is often seen as the tip of the spear for risky assets. Its price action gives us a peek into the risk appetite of the entire market. So its collapse wasn't just some isolated crypto event, it was a major warning shot. Okay, so this brings us to something that is genuinely alarming. If we look past all the geopolitical chaos and the day-to-day market swings, a very rare and highly specific technical indicator has just been triggered, and you need to know this. Historically, its track record is perfect. Now, to understand this signal, you just need to know one quick thing: the correlation coefficient. It sounds complicated, but it's not. It's just a number between -1 and +1 that shows how two things, in this case, Bitcoin and the S&P 500, move in relation to each other. A +1 means they move together perfectly. A -1 means they move in exact opposite directions. Simple enough, right? Okay, now let's look at why this matters so much right now. So here's the exact sequence that has analysts on high alert. First, the correlation between Bitcoin and stocks dropped all the way to -0.5. This happened during that time we just looked at when Bitcoin was falling but stocks were still going up. But then that correlation sharply reversed and started heading back up. It's this specific V-shaped pattern in the data that makes up the warning signal. And here is the absolutely chilling conclusion from analyst Tony Severino. When this exact pattern happens, that drop to -0.5 followed by a sharp turn back up, it has historically been a powerful signal that a major stock market collapse is coming. And it's a collapse that drags Bitcoin right down with it. And when I say historically, I mean it. Just look at this track record. This isn't some signal that, sometimes works. The last 3 times it flashed in 2018, 2020, and 2022, it was followed by a major market crash. Every single time. So what exactly does a major crash mean here? Well, based on what happened those other times, a correction of this magnitude could mean a price fall of 70 to 80% from the recent market peaks. A number that's stark, it's almost hard to wrap your head around. All right, let's tie all of this together. What does a war in the Middle East, spiking bond deals, and some secret crypto signal actually mean for you and your financial future? What we're looking at right now is basically a perfect storm. You've got extreme geopolitical instability choking off the world's energy supply. You have rising borrowing costs that are hitting every single American household. You have a market that is so on edge it can swing hundreds of points based on a tweet. And then, simmering under all of it, you have this historical indicator with a flawless track record that's screaming that a major collapse is right around the corner. So, the final question is this. Are these wild swings we're seeing just temporary turbulence, the market trying to figure out a chaotic world? Or is this something way more ominous? With all these forces converging at the exact same time, are we just witnessing the calm before the storm?